Every year, most American homeowners over 65 open the same envelope, look at the same property tax bill, and pay it. The number is higher than last year. It almost always is, and they pay it the same way they've paid it for the last 20 or 30 years, because that's what you do. That's just what owning a house costs. And you think, the bill arrives, I pay it. That's how this works. Here's what that assumption is actually costing. The average American homeowner over 65 pays $4,271 a year in property taxes. Every state in this country has programs specifically designed to reduce, freeze, or eliminate that exact bill for seniors who qualify. And only 8% of the people who qualify have ever filed an application. 8%, the other 8.3 million homeowners who are legally eligible, just keep opening the envelope and paying. Not because the programs aren't real, because the county sends the bill and waits. Nobody calls, nobody explains it. The bill arrives and most people pay it every year for the rest of their lives. Over a 20-year retirement at current bill increase trends, that $4,271 compounds. By year 20, the average bill has crossed $9,300 a year. Total paid approaching $127,000. That is the default path, and it runs automatically unless you do one specific thing. What I want to walk you through are the 4 programs built to interrupt that path. Most people know vaguely about the first one, the assessment freeze and the deferral program. Those are the ones almost nobody has heard of, and they're the ones that change the math most for the people who need it. My name is Frank. Let's talk about what your county hasn't told you. Before we get into it, comment below. Before today, did you know your state had programs that could reduce or freeze your property tax bill at 65? Yes, no, or you'd heard it existed but never looked into it? Drop it below. I read every one. Let's start with the most widely available program, and the one the largest number of eligible seniors are simply not enrolled in. Senior homestead exemptions exist in more than 45 states. Once you're 65 and you own your primary residence, you typically qualify to apply for a reduction in your home's assessed value, the number the county uses to calculate your bill. The math works like this. The national effective property tax rate is 0.86% of home value. On a home assessed at $380,000, close to the current U.S. median, your baseline bill runs roughly $3,268 before local levies. A typical senior homestead exemption reduces that assessed value by $25,000 to $75,000. At 0.86%, a $50,000 exemption saves approximately $430 a year. Not dramatic on its own, but this is layer 1, and it stacks with every other program on this list. Here is what almost nobody knows. The exemption does not apply automatically. The moment you turned 65, nothing changed in the county records. No flag was updated. The same full bill you paid at 64 arrived again at 65, unless you contacted the county and applied yourself. In virtually every state, the senior exemption requires an active application filed within a specific annual window. The county assumes you will keep paying the full amount. In 92% of eligible cases, they're right. Here's where it gets counterintuitive, and where the real long-term money is. 16 states offer some form of assessment freeze specifically for seniors. 6 offer a complete tax freeze, where your entire bill is locked at the amount you paid when you first filed. 10 more lock the assessed value of your home, which accomplishes the same thing as property values rise. The 6 full freeze states are Connecticut, New Jersey, Oklahoma, Rhode Island, Tennessee, and Texas. Here's why this matters more than the exemption itself over a retirement. If you file a freeze at 65 on a home worth $380,000, your tax is always calculated on $380,000, even if that same home is worth $600,000 15 years from now. Without the freeze, your taxable value climbs with the market every year. At year 15, the numbers look like this. Without a freeze, your annual bill is approximately $6,074. With the freeze in place, roughly $3,841 a year. That's $2,233 a year in savings from a single application filed a decade and a half earlier. That gap compounds every year you hold the home. This is the program that generates the most savings over a 20-year retirement, and in most of the 16 states that offer it, it sits completely unclaimed in the majority of qualifying households. The exemption saves you $430 a year. The freeze protects you from everything that happens to property values after you file. They are not the same thing. Most people have only ever heard of one. Now for the one with the name that sounds like it belongs in a fuse box. Circuit breaker programs work like this. When your annual property tax bill exceeds a set percentage of your household income, the state provides a credit to bring the bill back below that threshold. The idea is that the circuit breaks before the load gets too heavy. This program was specifically designed for the senior living primarily on Social Security, someone who owns a home outright worth $400,000 or more, but lives on a fixed income where a rising tax bill takes a larger slice of the monthly budget every year. For a household bringing in $58,000 a year and paying $4,271 in property taxes, that's more than 7% of gross income going to the county alone. Most states offer this program, though thresholds and income limits vary. Some require annual recertification with proof of income. This is also where most people stop watching. They found the first two programs and feel good about what they got. What they miss is the deferral option and the deadline mechanics that make every program on this list conditional. Remember the $127,000 from the beginning? This is where the two paths fully separate. This next one works differently from everything else we've covered. It doesn't reduce the bill. It doesn't freeze it. It tells the county, not this year. A tax deferral program allows qualifying seniors to stop paying their annual property tax bill entirely. The outstanding amount accumulates as a lien on the property. When the home is sold or the owner passes away, the balance is settled from the proceeds. This is the program for the person who is cash poor and equity rich. The retired homeowner with no mortgage, significant equity, a home they plan to stay in long term, and a fixed monthly income that doesn't stretch far enough to cover the property tax bill without real strain. Interest on deferred taxes is capped by most states, typically between 3 and 5% annually. Some states charge nothing. At 5%, deferring a $4,271 bill for 1 year costs $214 in interest, often far less than the cost of liquidating savings or cutting monthly spending to cover it. If that changed how you think about what's actually available to you, hit like. It tells me these videos are reaching the people who should see them. Here's the question I get every time I cover something like this. If these programs are real, funded, legal, written specifically for homeowners over 65, why hasn't the county ever mentioned them? Why doesn't the annual tax bill come with a note? The answer is simple. The county collects more revenue when you don't claim the exemption. This is not a scheme. It's just how the system works. Nobody at the county has a job whose function is to find relief programs for you. Their job is to process whatever you send in. The exemption exists. The application exists. The legal right has been sitting in most state tax codes for decades. What doesn't exist is anyone whose responsibility it is to explain it to you. The bill arrives. They wait. Most people pay it. That is the complete answer to why 92% of eligible seniors have never filed. Here's the piece that makes every other program on this list conditional. Most states require you to file your senior exemption application between January 1st and April 1st of the year you first qualify, typically the year you turn 65. Miss that window, and you lose the exemption for the entire tax year. In most states, there is no retroactive recovery. You wait until next January and begin again. In states with an assessment freeze, the consequences of a missed deadline go well beyond one lost year. The freeze locks your assessed value at the time of filing, not the time you turned 65. Every year you delay is a year of additional home appreciation baked into your baseline. File 3 years late and your freeze is set 3 years of appreciation higher. Every tax calculation for the rest of the time you own the home is made against that higher number. The compounding cost of a late freeze applies for every year you remain in the property. This is why the year you turn 65 is not the year to get around to it. It is the year. 2 questions to ask your county assessor before anything else. What senior programs does your county offer? And what is the application deadline for each one? One more thing before the close. Because this is the number I want you to carry out of this video. The combined effect of a homestead exemption and an assessment freeze filed at 65 on a median-priced home generates estimated savings of $24,000 to $96,000 over a 20-year retirement. Those are published figures from 2026 property tax research, not a projection I'm building. The midpoint of that range is $60,000. Let that land for a second. $60,000 that stays in your household over a 20-year retirement from a form that most county assessors estimate takes about 20 minutes to complete, that the county has never mentioned to you and has no plan to. The exact number will depend on where you live, what your county offers, and when you file. But the math works the same direction for everyone who qualifies. The earlier you file, the more the freeze protects you. Waiting has a cost, and that cost compounds. Here's what to actually do this week. Call your county tax assessor directly. Not a state agency, your specific county. Tell them you are a homeowner over 65 and you want to know every senior property tax relief program available. Ask specifically about homestead exemptions, assessment freezes, circuit breaker credits, and deferral programs. Ask the deadline for each. The documents you typically need: proof of age, proof of primary residence, and for income-based programs, your prior year federal tax return. For programs that require annual recertification, most income-based credits set a recurring calendar reminder each January. That is the only ongoing action required. One phone call, one application, 20 minutes. Let me be specific about what this means for where you actually are right now. If you're in your early to mid-50s, the most useful thing you can do with this information is prepare before you need it. Find out what your county offers and what the deadlines look like before you turn 65. The people who plan this in advance never miss the window, and they start collecting savings from the first year they qualify, not the second or third. If you're between 65 and 75 and you haven't filed, there is a specific tightening in the chest that comes with realizing a bill has been running higher than it had to be. That feeling is accurate, and the savings from here forward are real. One phone call to your county assessor this week begins the process. In most states, the exemption applies from the year you file. Ask specifically whether there's any pathway to recover prior year overpayments. If you're 75 or older and a property tax bill is quietly putting real pressure on a fixed monthly income, the deferral program and the circuit breaker credit were built for exactly your situation, not as a last resort, as a tool the state placed in the tax code for exactly this reason. The people who use them stay in their homes on their own terms. The ones who don't sometimes make housing decisions under financial pressure they were never supposed to be carrying. The bill is going to keep arriving. That won't change. But the amount on it, it was never as fixed as the autopay made it feel. If this was useful, subscribe. The next video covers the property tax freeze versus the exemption, which one is worth more, and how to get both. And it picks up exactly where this one left off.